So the next topic that we are going to learn is about ACCA 330, that is risk responses with respect to the auditor's assessed risk of material misstatement in the financial statement. So this particular ACCA explains that once the auditor has identified the ACCA as per the ACCA 315, the respective risk of material misstatement for the financial statement, he needs to create adequate responses how he is going to tackle such a risk. Like what are the procedures he's going to implement to ensure that he can reduce the risk to a acceptable level. So risk responses is all about the test that he is going to carry on. So let us say, for example, we are going to Bangalore by car. I told you this example in one of the videos, and one of the risks that we could incur is that the car could break down. So we are not traveling now, right? So let's say we are planning for the travel. Let's say we are 1 month before the travel, and we note down what are the potential risks we could incur because we are traveling by car. So the car could break down. So now itself what I will do, okay, a risk is car could break down. The potential responses or the appropriate response if a car breaks down is that I need to get my car serviced and ensure that the car is in a good condition so that I can minimize the damage. Or I can note down during my travel in road car trips where is my car service stations nearby, and also get a roadside assistance details so that I can reach out to the roadside assistance on timely basis. So to ensure that the auditor actually obtains appropriate audit evidences, he needs to assess the risk of material misstatements as well as implement appropriate responses to those risks, which will help him to form an opinion. This will help the auditors focus on his testing or prioritize his testing, and will help him to minimize the detection risk. See, audit is a planned process. It's a 6 months, it's a minimum 1 month to maximum 6 months of time period of process. Some odd companies, it can go up to 8 months, 9 months as well. Or it can be throughout the year also. Like if it is a very huge and big company, it can be throughout the year as well. It's a concurrent audits, etc. So during the period of time, the auditor could face issues where he might be under pressure and he's unable to complete the test or procedures, or unable to finish the procedures. That's why we are planning it so well that we note down what are the potential risk of material misstatement that could be identified in a financial statement and focus on that first. So we'll prioritize to finish those risks first, to gather evidences with respect to those risks first. And then the other accounts which are less risky, then we can focus it later. But when we do substantive procedures, our primary focus is to gather evidences relating to the risk of material misstatements or higher risk of material misstatements. So when you are given a scenario, you might be asked to identify the risk as well as give explanations related to the risk. At the same time, you might be given to assess the give the responses to the risk of material misstatement. Like as an auditor, how do you respond to this risk that have been identified? A typical risk question, how you can answer is through these questions, asking these questions to yourself and trying to identify the answers from the scenario. The first one is what, which means what is the risk. So you will read the scenario and identify the risk. You go and identify the risk and note down. So you will need to identify the risk given in the scenario, right? You can use maybe the same sentences that is given in the scenario as a part of your answer when it comes to what. The second one is why. Why do you consider it as a risk? To answer why, you need to explain the impact of the risk on financial statements. What is the impact of the risk on the financial statements? What could potentially go wrong? WCGW. What could go wrong? Which explains your fear as an auditor. To give you a simple example, let's say the customers are struggling to pay the debts. That is what is given in the scenario. So the risk is that the customers, so in what is the risk? We will write, okay, customers are struggling to pay the debts. That is a risk. Now, why it is a risk? What is the impact on the financial statements? What could go wrong? If the customers are struggling to pay the debts, then receivables could be overstated. Receivables could be overstated if irrecoverable debts are not written off. If the irrecoverable debts are not written off, then the receivables could be overstated. So it's a simple explanation. I mean, this is not the standard that is required for your, definitely for your AAA subject, but I'm just giving you as an example. That's it. This is just a simple example for you to note down. That's it. But this is not the standard answer that we need to write. In AAA, we will go deeper. In AAA, for why it is a risk, you will also have to explain the relevant IFRS standard. You need to quote the details of appropriate accounting as per IFRS. So you need to explain like which IFRS it gets impacted here, like if it is receivable, if it is irrecoverable debts, whether it is IFRS 9, financial instruments could be come to picture. You need to pick up points from the scenario and explain if there are any wrong accounting principles that have been used, then you need to explain that that is wrong. If you need more information, you need to explain you need more information. So you can say you can identify, you should also identify the incorrect treatment. Incorrect treatment as per the scenario compared to IFRS. And if you need more information, then you need to write you need more information and details, which will help you to score the professional marks as well. So that will explain for the why. For AAA, majority of your majority of your questions will be to explain the what and the why. The audit risk, you're required to explain the what and the why in a deeper way. Like you have to write at least one or two paragraphs about what as well as the why. And the last one is how. Now, how do you respond? How to respond to the risk? In order to respond to the risk, you will write what are the audit procedures to be conducted. Audit procedures that you will conduct in future tense, in future. So what are the procedures you're going to do in future? That is the how do you respond. All your procedures will be in A, E, I, O, U. You will inquire with the directors, inquire with the management. You will talk to the management why this wrong entry is being posted. You will talk to the inspector, the books to see where the issues are, etc. So in terms of responses where, receivables could be overstated, you could easily write a response as, let's say, for example, inspect the post year-end cash receipts. Inspect the post year-end cash receipts to review any provision is required. You can say, okay, review aged receivables listing to identify old debts. And then discuss with the management regarding their, what are you going to discuss? You're going to discuss regarding the necessity of allowance to be made. So whether an allowance is required or not, you need to discuss with the management. You can also say inquire with the management regarding the allowance requirement, etc. That also you can explain. So these are all relevant responses. So your audit procedures will be your AEIOU, analytical, inquiry, inspection, observation. You can do comparisons, current year versus prior year. You can do inspections. You can say you can observe how the controls are being tested, etc. That will be the relevant responses. So to quickly understand, this responses, or to quickly practice these responses, let us do one activity, which is activity number 2. This is Bauer company. So you are an audit partner attending the planning meeting of the audit of Bauer, a large technology company with 2 main divisions. The year end is 31st December. The first division manufactures computer hardware for use by intelligence and security agencies, and the second produces and distributes bespoke and off-the-shelf software to use on the hardware. As part of your audit planning, you attend a meeting with Bauer's finance director, Jackie. She informs you that there have been no major changes of the business operations during the year, but the following significant events had occurred. Owing to an unexplained improvement in the security situation in the Los Angeles area, a significant contract with the US government for new hardware has not been renewed. This was a surprise, and as a result, 100 of the US staff were made redundant during December. Okay? During the year, the development commenced a new software for using satellite tracking vehicles. This has been capitalized as an intangible asset. In order to commence development, significant staff training costs were included. So this is 2 of the most common risk that could be asked in your examination or in your scenario. So that's the reason why I like BPP quite a lot. The activities are very much relatable to the exams themselves. So even though the depth of the answer is not severe, but the question is very much relevant to the scenarios that you get when you're writing an exam. So let's, detailed out, talk about these 2 risks, number 1 and number 2. Number 1, owing to an unexplained government improvement in security in Los Angeles area, significant contract with the US government for new hardware has not been renewed. So Bauer Technologies used to have a government contract, but due to some changes in security situations, the government contract they had did not get renewed. So hence, what happened was, people who were working for this particular contract, 100 of the US staff were made redundant, which means they were asked to leave. Now the risk here is the timing. Okay, this is the timing. That is specifically to point out the risk. Now when there is redundant, what do you do? When there is redundant, you will create a provision. So the question here we are trying to answer here is whether a provision is required, a redundancy provision is required or not. And here the risk is a bit more heavier because of the timing, because they were made redundant during December. Question comes when they were announced for the redundancy. Like, have they announced it before the year end, 31st December? If yes, then provision of redundancy is required as per IAS 37. You have to charge a provision for the current year, because of, if for example they were announced for redundancy, the 100 staff were given redundancy announcement before the year end. But if the announcement was made in the next year, then provision will be recognized only in the next year. Provision will be recognized only in the next year. So that is the first issue, right? So you can say that as the timing of the redundancy is near to the year end, it is important that whether the announcement was made before the year end or not. If it was made before the year end, then a provision is required for any redundancy cost to be paid. But if the announcement is made post year end, then the cost would not be recognized until the next year. The second aspect, so this is the first one. The second aspect talks about the disclosure in relation to the disclosure cost in relation to the redundancies. Like, they have to be, as per IAS 1 presentation, redundancy cost have to be disclosed and should be disclosed very heavily in the financial notes to the financial statement. So that is another risk. Have they done the disclosure properly or not? The third risk is, if you look at here, what happened to the contract? The contract lead to a situation where 10% of our staff, around 100 people, were made redundant, which means there is a chance that there could be an unexpected loss. So the unexpected loss could lead to what? Unexpected loss could lead to ISA 570 going concern. So going concern uncertainty. So auditor have to inspect or audit with respect to the going concern uncertainty for the company. So you need to question the client whether they have done a going concern assessment and whether this is going to affect the loss of contract is going to affect the going concern or not. Alright. So consideration. So even then, this should be form part of the overall assessment of going concern, where there is a potential security situation which led to the closure of the contract. Consideration should be given to improve the security situation and whether similar improvements may occur in other markets or not. Like, if we have other markets, other customers, the same situation of security, lack of security, whether it could lead to other contracts or not should be considered. Like, if we have government contracts with any other cities, then that will be included or not should be considered. So this is how you need to explain. So here, if you look at here, how am I responding? I'm responding, what is the impact? I'm responding, what is the impact? So the question here is to evaluate the risk of material misstatement. They are not specifically talking about what will be the procedures you're going to do. So I'm talking about what is the risk, which is the provisions. Second, I'm telling what should be the impact and quoting the standard. If you are able to quote the standard, you will be given professional marks. If you're not, then at least not able to quote the name of the standard, at least write as per IFRS or as per IAS. Then I'm talking about the impact and inclusiveness, what the auditor should be doing to tackle these kind of risk. The second one is, during the year, development commenced on a new software of satellite tracking the vehicles. This has been capitalized as an intangible asset. In order to commence development, significant staff training costs were incurred. So here there is this risk is relating to IAS 38 software and development cost. Now the software development cost needs to fulfill the standard IAS 38. And in IAS 38, there is a specific criteria which is pay rate. The pay rate condition have to be met if you want to capitalize any IAS 38 intangible assets. And only if the condition have been fulfilled, we are eligible to capitalize. So the question comes whether the development costs that have been capitalized, are they allowed to be capitalized as per IAS 13, have to be reviewed. The second important aspect is relating to the staff training cost. It is important to ensure that training costs are not included as per the amount capitalized because they do not represent part of the software cost. The training cost have to be expensed off. Training cost have to be expensed off because you cannot have control over the staff. So whatever cost that you spend to train the staff have to be expensed into P&L rather than capitalized. So these are the risks and these are the explanations how we're gonna approach the question that is given to us.